One of the drivers of the equity rally this year is that the investors are optimistic that the Fed is either done raising interest rates or very close to being done interest rates. You also have investors hoping on and banking on the fact that the Fed will be able to come in and cut rates as soon as growth takes a downturn. We're not as optimistic that the Fed's going to be able to come in and save the day in this scenario. Inflation, while it's improving significantly in the second quarter, it still is too high for the Federal Reserve. They can't come back in and become dovish on their interest rate policy without also fueling economic growth. So we think the Fed will probably take a pause this summer, reassess in the second half of this year, but we aren't expecting rate cuts in the economy until well into 2024. There's three things that we have to watch with what the Fed's going to do. It's wage inflation, housing inflation, and services inflation. All three of these things are considered sticky, and all three of these are still growing well above what the Federal Reserve would like them to do. So until we see a much-needed improvement in those areas of inflation, we don't think that the central banks are able to take a dovish stance or insinuate that rate cuts are anywhere on the horizon.